Here's a question worth pondering. Why do some investors consistently generate excellent returns over decades, while others, often equally intelligent and hardworking, struggle or fail? Is it access to better information, superior analytical capabilities, luck? The uncomfortable answer is simpler and more accessible than most people realize. The difference lies almost entirely in how they think. The best investors don't have secret formulas or inside information. They don't possess superhuman intelligence or predict the future. What they have is a collection of mental models, thinking frameworks that help them see reality more clearly, make better decisions under uncertainty, and avoid the catastrophic mistakes that destroy most people's wealth. Charlie Munger spent his career emphasizing that you don't need to be brilliant to be a successful investor. You need to be rational, patient, and equipped with the right mental models. He famously said that it's remarkable how much long-term advantage you can get by trying consistently not to be stupid, rather than trying to be very intelligent. This is the essence of mental model thinking. It's not about being the smartest person in the room. It's about avoiding stupidity more reliably than others. Most people approach investing backwards. They focus on finding the next great stock, timing the market perfectly, or discovering some hidden opportunity that everyone else has missed. This is chasing brilliance, and it rarely works. The investors who actually build lasting wealth do something different. They use mental models to eliminate bad decisions, recognize their own limitations, think probabilistically, and structure their approach so that, even when they're wrong, they survive to compound another day. Mental models are thinking tools. They're frameworks for understanding how the world works, how systems behave, how incentives shape outcomes, and how human psychology creates predictable patterns. When you have the right mental models, you see things that others miss. You avoid traps that others fall into. You make decisions that seem obvious in hindsight, but require genuine insight in the moment. The tragedy is that most investors never develop these mental models. They rely on intuition, follow the crowd, react emotionally to news, and repeat the same mistakes generation after generation. They learn tactics without understanding strategy. They memorize facts without developing wisdom. And they wonder why their results are mediocre despite their efforts. This video is about the mental models that actually matter for investing and wealth building. Not all mental models are equally valuable. Some are profound and applicable across countless situations. Others are niche or limited. We're going to focus on the models that successful investors use repeatedly, the ones that compound in value over time, the ones that help you avoid ruin and position yourself for long-term success. If you're looking for stock tips or market predictions, this isn't the right video. But if you want to understand how great investors actually think, how they structure decisions, how they protect against their own biases, and how they build wealth reliably over decades, then let's examine the mental models that make this possible. The first and perhaps most important mental model is the concept of circle of competence. This idea is deceptively simple. You have areas where you truly understand how things work, and you have far more areas where you don't, even if you think you do. Success comes from operating within your circle and being ruthlessly honest about where its boundaries lie. Most people dramatically overestimate the size of their circle of competence. They read a few articles about an industry and convince themselves they understand it. They hear a compelling story about a company and believe they can evaluate its prospects. They see others making money in an area and assume they can do the same. This is not rationality. This is overconfidence bias combined with wishful thinking. The intelligent approach is different. You identify areas where you genuinely have knowledge, experience, and insight. Maybe it's the industry you've worked in for 20 years. Maybe it's a type of business model you've studied extensively. Maybe it's a geographic market you understand deeply. Whatever it is, you know the landscape, you understand the key variables, you can evaluate claims critically, and you recognize when something doesn't make sense. Warren Buffett has generated extraordinary returns largely by staying within his circle of competence and saying no to everything else. He doesn't invest in technology companies he doesn't understand. He doesn't chase trends in industries where he lacks insight. He doesn't pretend to have knowledge he doesn't possess. This discipline, this willingness to admit ignorance, is a massive competitive advantage. The mistake most investors make is believing they need to understand everything and have an opinion on every opportunity. They feel inadequate if they don't know about the latest investment trend or can't evaluate every stock that's mentioned. This is ego talking. The rational approach is the opposite. You need to understand very few things deeply, and you need to avoid the things you don't understand, no matter how attractive they seem. Think about what this means practically. If you don't understand cryptocurrency at a fundamental level, how blockchain technology works, what gives different tokens value, what risks exist, then you shouldn't invest in it, regardless of who's making money or what the price is doing. If you can't explain how a biotech company's drug pipeline creates value, you shouldn't own the stock. If you don't understand the regulatory environment for a foreign market, stay away. This sounds limiting, but it's actually liberating. You don't need to be an expert in everything. You need to know a few things really well and restrict yourself to those areas. This is not about intelligence. Some of the smartest people make terrible investors because they can't resist venturing outside their circle of competence. They're smart enough to construct a plausible sounding investment thesis for things they don't actually understand. This is dangerous. The circle of competence mental model also tells you something important. You can expand your circle, but only slowly and carefully. If you want to understand a new industry or investment type, you need to study it seriously for years, not weeks. You need to read extensively, talk to experts, study failures as well as successes, and build genuine insight. Most people aren't willing to do this work, so they stay superficial and pretend they understand things they don't. Here's how this applies to your investing. Make a list of areas where you genuinely have competence. Be honest. The list should be short. Then commit to operating primarily within those areas. When opportunities arise outside your circle, the default answer is no. You need an extraordinary reason to venture outside, and even then, you should do so carefully and with limited capital. The second essential mental model is inversion. Instead of asking how to succeed, ask how to fail. Instead of asking what to do, ask what to avoid. This simple flip in perspective is remarkably powerful because it's often easier to identify what destroys wealth than what creates it. Carl Jacobi, the mathematician, famously said, "Invert, always invert." Charlie Munger took this to heart and applied it to investing and business. When evaluating an investment, don't just ask what could go right, ask what could go wrong. When thinking about your financial life, don't just plan for success, identify the actions that would guarantee failure and make sure you never take them. Let's apply inversion to wealth building. How do people destroy their wealth? They take on debts they cannot afford, especially for depreciating assets. They invest in things they don't understand because everyone else is doing it. They panic and sell at market bottoms. They confuse a bull market with genius and become overconfident. They fail to diversify. They trust the wrong people with their money. They let ego drive decisions. They make permanent choices based on temporary emotions. If you systematically avoid these mistakes, you're already positioned better than most investors. You don't need to find the next Amazon or predict the next recession. You just need to not blow yourself up. This is inversion in practice, and it's one of the most valuable thinking tools you can develop. The power of inversion is that it forces you to confront uncomfortable realities. When you ask, how could this investment fail? You have to think about scenarios you'd rather ignore. When you ask, what would ruin me financially? You have to acknowledge vulnerabilities you'd prefer to deny. This discomfort is valuable. It's the friction that prevents catastrophic errors. Consider how this applies to specific investments. Before buying a stock, don't just imagine the bull case. Force yourself to articulate the bear case. What could go wrong with this company? What would cause it to lose value permanently? How could I be wrong about this? If you can't answer these questions clearly, you don't understand the investment well enough to own it. Inversion is also powerful for life decisions. Want to have a successful career? Ask how people ruin their careers. Want a good marriage? Ask what destroys marriages. Want to stay healthy? Ask what makes people sick. The answers are often clearer than the positive formulations, and they give you concrete actions to avoid. The third critical mental model is probabilistic thinking. The world is not deterministic. Nothing is certain. Everything is a probability distribution. Successful investors think in terms of odds, expected values, and ranges of outcomes, rather than single-point predictions. Most people are terrible at probabilistic thinking. They want certainty. They want to know what will happen. They treat predictions as facts and then feel betrayed when reality diverges. This is a fundamental misunderstanding of how the world works. The rational approach is different. You recognize that any investment has a range of possible outcomes, each with different probabilities. Your job is not to predict which outcome will occur. Your job is to assess the probabilities, calculate the expected value, and make decisions that are favorable when repeated over many instances. Let me give you a simple example. Suppose you're evaluating an investment that has a 60% chance of returning 20% and a 40% chance of losing 10%. The expected value is positive, 0.6 times 20% plus 0.4 times negative 10% equals 8%. This is a good bet if you can make it repeatedly. But notice what this means. You'll be wrong 4 times out of 10. You'll lose money on 40% of these investments. That doesn't mean you made bad decisions. It means you understood the probabilities and took favorable bets. Over time, with enough repetitions, the math works in your favor. This is hard psychologically because humans hate being wrong, even when being wrong was the likely outcome given the probabilities. If you make 10 investments that each have a 70% chance of success, you'll probably have 3 failures. Those failures don't indicate bad decision-making. They're the expected result of probabilistic thinking. The investor who thinks probabilistically asks different questions. Not, will this work? But, what's the probability this works? And what's my expected return given those probabilities? Not, is this a good company? But, at this price, given the range of outcomes and their likelihoods, is this a good investment? This mental model also helps with position sizing. If you're highly confident in an investment, say 80% probability of success with a large upside, you might size it larger. If you're less confident but the math still favors you, you size it smaller. You're explicitly incorporating uncertainty into your decisions rather than pretending it doesn't exist. Probabilistic thinking also means updating your beliefs as new information arrives. This is Bayesian reasoning. You start with a prior probability based on your initial analysis. As you gather more information, you update. Maybe the probability of success increases or decreases based on new data. The key is holding your beliefs lightly and changing them when evidence warrants. The fourth mental model is second-order thinking. Most people only consider the immediate, direct consequences of their actions. They stop at first-order effects. Successful investors think further. They ask, and then what? What are the second-order consequences? The third order? How? Does this chain of causation play out over time? This matters enormously in investing because second-order effects often dominate first-order effects, and they are usually non-obvious. Everyone can see the first-order consequences. The investors who see the second and third-order consequences have an edge. Let's take a concrete example. A company announces it's cutting costs to improve margins. First-order thinking says this is good for profitability and the stock should go up. Second-order thinking asks, how are they cutting costs? If they're reducing research and development spending, what does that mean for their competitive position in 3 years? If they're cutting employee benefits, what does that do to talent retention and culture? If they're reducing quality control, what happens to brand reputation over time? Sometimes cost-cutting is genuinely beneficial. Sometimes it's short-term thinking that destroys long-term value. Second-order thinking helps you distinguish between these cases. Consider another example. Government stimulus during a recession. First-order effect is more money circulating, supporting demand and employment. Second-order effects might include inflation as money supply expands, misallocation of capital to unproductive uses, moral hazard as companies expect bailouts and long-term debt burdens. Whether stimulus is beneficial depends on weighing all these effects, not just the first-order ones. In your personal finances, second-order thinking is equally important. Taking on debt to buy a car has first-order consequence of getting the car now. Second-order consequences include reduced cash flow for years, less ability to invest, stress from the obligation, reduced flexibility if circumstances change, and opportunity cost of what else that money could have done. When you think through all these effects, many purchases look far less attractive. The investor who masters second-order thinking has a massive advantage. They see consequences that others miss. They avoid traps that seem appealing at first glance. They understand that complex systems don't respond linearly to interventions. The fifth mental model is understanding incentives. Charlie Munger called this the most powerful force in the world. If you want to understand why people do what they do, why organizations behave as they do, why markets move as they do, follow the incentives. Behavior is shaped far more by incentives than by intentions. This is crucial for investing because incentives explain so much that otherwise seems irrational or confusing. Why does your broker recommend actively managed funds? Follow the incentives. Higher commissions. Why does financial media focus on daily market movements and dramatic stories? Follow the incentives. Fear and greed drive clicks and viewership better than calm, patient analysis. Why do CEOs sometimes make decisions that benefit themselves but harm shareholders? Follow the incentives. Their compensation structure. rewards short-term stock price increases. The rational investor never takes advice or information at face value without first asking, what are the incentives here? What does this person or institution gain from me believing this or taking this action? This doesn't mean everyone is acting in bad faith, but incentives matter enormously, and they often create conflicts of interest that people don't even recognize. Consider sell-side analyst recommendations. These analysts work for investment banks that want to maintain good relationships with the companies they cover because those companies are potential clients for banking services. This creates an incentive to be overly optimistic. Understanding this doesn't mean you ignore analyst reports, but you interpret them through the lens of incentives. Sell ratings are rare because they damage relationships. Buy ratings are common and should be discounted accordingly. Or consider mutual fund managers. Their incentive is to gather assets under management because their fees are based on total assets. This creates pressure to look similar to their benchmark and avoid career risk. A fund manager who is very different from the benchmark might underperform in any given year and lose clients, even if their approach is sound long-term. So most funds end up as closet indexes, charging active management fees for passive-like performance. Understanding this incentive structure explains why most active funds underperform. The incentive mental model is also crucial for evaluating companies. How is management compensated? If their incentives are aligned with long-term value creation, that's positive. If they are incentivized to maximize short-term metrics or grow for growth's sake, that's concerning. Some of the worst capital allocation decisions in corporate history came from perverse incentive structures. In your own life, use incentives to your advantage. Structure your own incentives to align with your goals. If you want to save more, automate transfers so the path of least resistance is saving, not spending. If you want to invest consistently, set up automatic contributions. Make the behavior you want easy and automatic, and make the behavior you don't want difficult and friction-filled. The sixth mental model is thinking in systems and understanding feedback loops. The world is not a collection of isolated events. It's a set of interconnected systems with feedback mechanisms that can amplify or dampen changes. Understanding these dynamics is essential for investing. Consider a simple example. A company gains market share, which increases its scale, which allows it to reduce costs, which allows it to reduce prices or increase margins, which further increases market share. This is a positive feedback loop, and it can create powerful competitive advantages. Amazon's flywheel is a famous example. More customers attract more third-party sellers, which increases selection, which attracts more customers, and the loop continues. But positive feedback loops can also destroy value. A company struggling financially cuts investment, which makes its products less competitive, which loses customers, which worsens finances, which forces more cuts. This death spiral is hard to escape once it starts. Understanding these dynamics helps you identify which companies have structural advantages and which are vulnerable. It helps you see which trends are likely to accelerate and which are likely to reverse. It prevents you from extrapolating linearly when the underlying system has non-linear dynamics. Systems thinking also reveals where conventional wisdom is wrong. Often, what seems like a simple cause-effect relationship is actually a complex system with multiple feedback loops. Trying to optimize one part of the system can make the whole system worse. This is why simple solutions to complex problems rarely work as intended. In investing, recognize that markets are themselves complex adaptive systems with multiple feedback loops. Rising prices attract attention, which attracts capital, which pushes prices higher, creating a momentum effect. But eventually, valuations become stretched, which increases risk, which eventually triggers selling, which becomes self-reinforcing on the downside. Understanding these cycles doesn't let you time them perfectly, but it helps you recognize when you're in a speculative extreme. The seventh mental model is understanding opportunity cost. Every decision has a cost, not just the money you spend, but the alternative you give up. The best investors think constantly about opportunity cost because capital is finite, and every dollar invested in one place can't be invested elsewhere. This seems obvious, but most people neglect opportunity cost systematically. They evaluate each opportunity in isolation. Is this good? Would I make money? Do I like this investment? These are the wrong questions. The right question is this the best use of capital available to me right now? Is this better than the alternatives? Warren Buffett has talked about having a mental punch card with only 20 investment decisions for your lifetime. This thought experiment forces you to think about opportunity cost. If you can only make 20 investments ever, you become far more selective. You wait for truly exceptional opportunities. You don't waste punches on mediocre ideas. In practice, you have more than 20 opportunities, but the mindset is valuable. Every investment you make is using capital that could go elsewhere. The cost isn't just what you pay, it's what you could have earned with the next best alternative use of that capital. This applies to time as well as money. Time is your ultimate, scarce resource. Every hour spent researching one opportunity is an hour not spent on alternatives. Every hour spent on low-value activities is an hour not spent on high-value activities. Successful investors are ruthless about protecting their time and directing it toward the highest value opportunities. Opportunity cost thinking also helps with selling decisions. Many investors focus on whether a stock will go up from here. That's not the right question. The right question is, would I buy this stock today at the current price with new money? If the answer is no, you should probably sell, because by holding, you're implicitly choosing to invest at today's price. The capital tied up in this stock has an opportunity cost, even if you've held it for years. The eighth mental model is understanding the power of compounding, not just in returns, but in knowledge, relationships, and reputation. Compounding is the most powerful force in wealth building, but most people radically underestimate it because it's non-linear and backloaded. We've discussed the mathematics of compound returns elsewhere, but the mental model goes deeper. Compounding isn't just about investment returns. It's about anything that builds on itself over time. Knowledge compounds. What you learn today makes learning tomorrow easier. Relationships compound. Helping people creates goodwill that returns multiplied over decades. Reputation compounds. Being reliable and honest creates opportunities that wouldn't exist otherwise. The investor who understands compounding makes different choices. They prioritize long-term relationships over short-term transactions. They invest in learning even when the payoff isn't immediate. They protect their reputation as their most valuable asset. They give compounding time to work rather than interrupting it for temporary reasons. This mental model also reveals why small differences in approach compound into massive differences in outcomes. An investor who achieves an extra 2% annual return doesn't end up a little wealthier. Over 30 years, they end up dramatically wealthier because that 2% compounds. The same applies to everything else. Slightly better decisions, repeated consistently over decades, create extraordinary results. The key insight is that compounding requires time and consistency. You can't compound if you keep starting over. You can't compound if you interrupt the process. The investor who changes strategies every few years, who moves from one opportunity to another without consistency, who can't stick with anything long enough for compounding to work, will never experience its full power. If you've made it this far, you're clearly serious about developing the mental models that successful investors use. These frameworks aren't quick tricks or shortcuts. They're ways of thinking that improve your decision-making across all contexts, not just investing. This channel exists to explore these deeper principles of rational thinking, sound decision-making, and long-term wealth building. If this approach resonates with you, I'd appreciate if you'd like this video and subscribe. Not because I need the numbers, but because it tells me there's an audience for serious, thoughtful content about how to think clearly about investing and life. There's no hype here, no promises of easy money, no promotion of specific stocks, just timeless principles that actually matter, delivered calmly and honestly. Let me close with this thought. Mental models are not just intellectual tools. They're practical frameworks that change how you see the world and how you make decisions. The difference between successful investors and everyone else isn't intelligence or information access. It's the quality of their thinking frameworks. Most people never develop these mental models. They rely on intuition, follow conventional wisdom, react emotionally to events, and repeat the same mistakes that investors have made for generations. They wonder why their results are mediocre despite their efforts. The investors who succeed do something different. They build a latticework of mental models that help them see reality more clearly. They use circle of competence to know their limitations. They use inversion to avoid disasters. They think probabilistically instead of seeking false certainty. They consider second and third order effects. They follow incentives to understand behavior. They think in systems and feedback loops. They evaluate opportunity cost. They respect the power of compounding. These mental models compound over time. The more you use them, the more natural they become. The more natural they become, the better your decisions. The better your decisions, the better your outcomes. And over decades, this compounds into a massive advantage. This isn't easy. Developing new mental models requires effort. It means thinking carefully when it would be easier to react quickly. It means acknowledging uncertainty when you would prefer certainty. It means saying no to attractive opportunities outside your circle of competence. It means being different from the crowd when the crowd is euphoric. But the alternative is worse. The alternative is mediocrity, or worse, catastrophic losses from mistakes that proper mental models would have prevented. The alternative is watching others succeed while wondering what you're missing, when what you're missing isn't information but frameworks for thinking about information. The good news is that these mental models are available to everyone. They're not secrets. They're not proprietary. They just require study, practice, and the intellectual honesty to admit when you don't know something or when you're thinking incorrectly. Start with one model. Master it. Use it repeatedly until it becomes second nature. Then add another. Over years, you'll build a collection of thinking frameworks that give you genuine advantages. You'll see things others miss. You'll avoid traps others fall into. You'll make better decisions more consistently. The world will continue to be complex, uncertain, and often irrational. Markets will swing from greed to fear and back again. Opportunities will arise and disappear. Risks will emerge from unexpected places. Through all of it, the investor with sound mental models will maintain perspective, make rational decisions, and compound wealth steadily over time. That's the path. It's not exciting, it's not fast, but it's the path that actually works, that actually builds lasting wealth, that actually separates successful investors from the rest. The question isn't whether you're smart enough. The question is whether you're willing to think differently, to develop these frameworks, to use them consistently even when it's uncomfortable. If you are, the rewards compound over a lifetime. Thank you for watching. Now go build your lattice work of mental models.